All right, so now we are finally moving into chapter 3, where we're going to talk about transaction and transaction analysis, okay? So chapter 3 is going to be talking about how we actually use the concepts that we just learned in chapter 2 and how we organize our ideas and how we actually use those accounts to put them in a general journal to reflect that a transaction has occurred. So we're going to start off with, of course, the chart of accounts. So what is a chart of accounts? It is basically a list, okay, of all the accounts that exist in your company. So it's a list of all the accounts that are to be used in your general journal to recognize and to organize your transactions, okay, according by account type. All right? And each account and everything that's in there. So it's organized by account type. So usually you'll have your assets first, then your liabilities next, then your equity, then your revenues, and then lastly your expenses. Okay. So once again, we've seen what this chart of accounts look like in QuickBooks, right? We talk all about it, especially in chapter 12 where we set up our chart of accounts. So therefore, these accounts right here are going to be everything that we're going to be using in order to journalize our transaction. So if we don't have an account that exists to reflect our transaction, then we would just simply create one. Okay. Now, as far as this, it will always be organized according to account type. Okay. If you use account numbers, which you do not always have to have, you either find some kind of pattern. So in this case, it's similar to QuickBooks, right? Your 10,000s are going to be your assets. Your 20,000s are going to be your liabilities, so on and so forth. Okay. So that's how we have it organized. Okay. Now again, you're not obligated to have account numbers, and as you progress throughout your company's lifespan. So as you go through doing the books for an account for a company, you're always going to expand your chart of accounts. So whatever, it's not like you have a pre-notion of exactly what's going to happen in the future, right? You do create accounts all as you go and build your profile, okay? So again, chart of accounts, you can't really rely on account numbers, okay, or account names. You just know that it's always going to be organized by account type. Okay? So here we have a bunch of accounts. We have checking, accounts receivable, inventory. We have loans, equity, sales, expenses. Okay.
One question. That's what you call domain?
Say it again.
Checking an account. You remember before we learned about, for example, an asset, the main and contra, and so checking account receivable. That's what you call the main, and the sub account.
It really depends. Right now, it's just a list of a bunch of accounts. It's not organized in a way where if when we dive into the fictitious business, it will be definitely organized based on main and sub accounts. In this case, this is just an example of what a chart account looks like.
Okay.
Okay. So not necessarily main and sub or anything like that. It's just an example. I'm showing you what a chart of accounts looks like. Right. So now we are finally being able to look at a general journal. Now, what is a general journal? This is going to be a book or a journal, right, that allows you to record any business transaction that happens. Okay? So it's a place to record your transactions. So, pretty straightforward. This is what it looks like, right? When we dive into using Excel to demonstrate how a chart of accounts looks like, right? I've uploaded in the study materials an example of an Excel file that uses a general journal. So again, you can use that for practice purposes, okay? However, I'm going to show you this is how we would do it if you were manually writing your transactions down, okay? So it's nothing like QuickBooks, because QuickBooks is it's already preset form, right? You don't have to indent or anything like that. You just fill in the account numbers and everything does it for you, right? In this case, when we are manually doing a bookkeeping system, right? This is how you properly journalize a transaction, okay? Very first thing is you're going to start off with number 1 is the date, okay? Everything that is in relation to a transaction must be in chronological order. Meaning, if it happened today, you record it today. If it happens tomorrow, you record it tomorrow. Each day that a business is going through a transaction, you must record it that very same day in the exact order of the day. So you can't be putting January 1st here, then January 10, and then go back to January 5th. No. Usually these happen at time when you are recording at time. So if you purchase something on the 10th, but you forgot to record it on the 5th, or I'm sorry, on like the 20th or something like that, we'll talk about what happens when we have to do correcting errors. If that's the case, and whatever day that you found it, right, in the notes, you write that this is for the transaction that happened on this day, okay? But the idea here is that as a transaction or a business transaction has happened or an event that has happened, you record it chronologically, okay? Right? In order, by date. Okay? Then the meat of your journal is going to be your description. Your description can hold 2 things, right? It will definitely hold, number 1, which accounts you are going to be using. So in this case, the very first transaction here is example of purchasing furniture, right? This is me using the double entry system by saying I spent cash to buy furniture. Okay, so since I acquired furniture, I increased my assets, but at the same time, I decreased my assets because I spent money in order to acquire furniture. Okay, and again, the description here, when you do your accounts, it's going to reflect exactly the account name that you have in your chart of accounts. But for practice purposes only, I will let you practice however ways that you understand the transaction, okay? But most cases, the description is mostly for the account names. No acronyms, no shortcuts, no anything, okay? You should generally use the full name, the actual name that is listed in your chart of accounts, okay? Now, oftentimes, again, if you do rent expense, you could do rent EXP again. This is for practice purposes only. I'm not going to bog you down on it. If you do rent EXP, that's fine. Okay? Just know how you're doing it and why you're doing it. Okay? And then the description of what the actual event happened usually is going to be in parentheses. Okay? Doesn't matter what it is, as long as it comes at the very end of the transaction. So in this case, I wrote it in parentheses. I have it italicized and in the middle. It doesn't matter, okay? As long as it's in parentheses. It could be bold, it could be small, it could be italicized, it could be underlined. Whatever way that you want to be able to memorize or just to determine what this transaction is, as long as it's in parentheses, okay? And here I just wrote purchased furniture for shop. Straightforward. Okay. Now, how we actually organize this is going to be written exactly like this. Your debits accounts will always come first. Okay? And then your credit accounts come last. Okay? So once again, when we journalize a transaction, your debits will always come first, and then your credits will come last. Now, the great thing with technology is that if you do end up making those mistakes, it's easy, right? You just delete it and start over, okay? Now, a lot of students also ask me, how do I know which accounts go first? Like, how do I know which account to debit? Okay, that's why you have Excel for a reason. Type them all up. Try to figure out which accounts are going to be debited and then reorganize it, right? That's the purpose of this class, is that we're using technology to record a transaction. But if you're handwriting these transactions, unfortunately, there are specific criteria that you have to have. You cannot cross out, delete, or anything, right? Just like what we learned in QuickBooks, right? You can't delete transactions because it will cause discrepancies in your accounting, okay? But in this case, right, debits come first, credits come last, okay? Now, once we do that, the next section is going to be your post reference. Your post reference, this number here, right, is only if you use account numbers, because these are the account numbers that are directly correlated with that account. So, for example, account 10100 is, if you look at your checking account right here in my chart of accounts, that is account number 10100. So that's the post reference right there, is whatever account that you're using, you're going to put those account numbers in there. Okay? That's how you double confirm that you are using the correct account and which one that you are using. And then last but not least, we have the idea where we need to put our debits and our credits in the correct column, right? And this is what I was talking about and why we made the idea where your credits are on the right and your debits are on the left, because exactly how you see it in this journal, right? You have a column on the left and a column on the right. Left is for debits, right is for your credits. Okay? And when you go ahead.
The post reference, you give the number, or is the number account that is exist? That's the number always.
It just depends on what your company does. So if for QuickBooks, obviously for QuickBooks, it's already assigned, right? You can create some kind of your own methods of keeping track of your own accounts, right? If you want to associate all your assets with the letter A, okay, go ahead and make your account A100, right? And your liabilities are L200. And your equity is E500, okay? Whatever method that it makes sense to you to organize yourself. Now, in this case, I'm just going to keep it very plain and simple and use a 5-digit coding system. Okay? So the account numbers could be whatever you'd like to assign it to be. Okay? As long as it's like some kind of easy enough and readable system, okay, series, make sure that you're able to tell what they are. Okay. And then, of course, once you have your debits and your credits in place, your number one thing before you complete this transaction is to ensure that your total debits equal your total credits. So for the example, for the second example here on January 5th here, we have a split credit, okay? We have rent expense for $500, and then we have prepaid rent for $1,000, giving me a grand total of checking to be a total of $1,500. Right there, my total debits and my total credits match. And this is using the double entry system. Okay. All right. Any questions?
Nope.
Okay. Now, there's also a few little things here too. So I missed this little section here where when you do put your debits first and your credits last, the way that you write them or the way that you organize them on the paper is that normally your debits are going to be left aligned and your credits are going to be indented. Okay, this is just so then it's easy to recognize. When you look at a transaction, you're able to recognize which one's your debits and which one's your credits right off the bat. Instead of having to go through each account and then look at the debit and the credit columns, right? because you could get confused. In this case, this way makes it a lot more easier to just look at a transaction and be like, okay, got it. We have a debit and a credit by the way that you put in your accounts. Okay? So then now we can talk about transaction analysis. Okay? So transaction analysis. So this is where we're going to take a transaction and we're going to go through a series of questions. In this case, a 7-step process to determine whether a transaction needs to be recorded in the general journal or not. All right. So step number 1, okay, is going to be when you have your source document, of course, you're going to recognize, did a transaction happen? Did it occur? How did it occur? Why did it occur? And how does this affect my business? Okay? So that's the very, very first thing that you have to do is you got to collect your source document and you have to recognize what happened here. Okay? Number 2 is going to be analyze how this transaction affects your business, right? In this case, right, if I purchase furniture from my store, for sure that affects my business because I'm buying furniture for my customers to sit down on, or maybe I need a table to be able to, create my product, etc., right? You're going to determine how this transaction affects your business, okay? And by doing so, right, you're going to be looking at looking at your chart of accounts, of course, and that's where you're going to be determining, okay, whether this transaction is going to be increasing or decreasing in an account by using the debit and credit system, right? So here, number 2 says we have to figure out, how do we analyze this transaction, right? We ask those questions. What happened? How did it happen? Why did it happen? To help us understand how this transaction affects my business. Then step 3 determines, well, how does it increase my assets? Does it decrease my liabilities? How does this transaction affect my business? And then if I am able to determine, right, what accounts I'm going to be using or what accounts that are going to be affected, I go ahead and use step number 4 where I go into my chart of accounts, my business chart of accounts, and I'm going to look up to see if I have those accounts existing in my books. So then it gives me more validation that I can record, okay? If my account isn't there, what you normally do is you're going to either ask the accountant to create an account for you, okay, because they're going to be looking through the chart of accounts, and if they do find an account that exists for this transaction, they'll tell you what it is. But if there isn't one, they'll create a new account, okay? Then number 5 says using the debit and credit system, right? So in this case, number 3, we recognize, well, which accounts would be affected. Number 4, I'm going to determine whether I have those accounts in my chart of accounts. Number 5, that's where I apply my debit and credit system rule. Right? Then number 6, right, says, well, I need to determine which book or which journal to be able to record these transactions, which is straightforward, right? In this class, I'm going to keep it really straight and simple. You only have one general journal, okay? Now, if you're working for a company or a small business, they might have multiple journals, okay? One for sales, one for inventory, one for purchase orders, one for the main operating of expenses, etc., okay? In this case, we're only going to be using one book and one book only, which is just the general journal, okay? And then last but not least, step number 7, just like the Nike logo says, just do it. Record the transaction in your journal. Okay? Okay, easy enough. Okay. Any questions here?
No.
Okay. So then let's go ahead and talk about correcting entry. So once we figure out, right, how to journalize, there you go. So let's talk about correcting entries, because oftentimes when we do as a beginner, we're still in the learning process of how to record a transaction. Now, in this case, when we mention if you're doing a manual bookkeeping, you're handwriting all of your transactions, this is the rule here. You cannot delete, you cannot cross out, you cannot black out, you cannot white out, you cannot scratch out, you cannot tear the page out, okay? Because that's a big no-no, because that right there is a possibility for fraud. And you definitely don't want to do that, especially if you're working for another company. But because we are using Excel to help us record these transactions, then of course you're able to, fix your mistakes pretty quick and pretty easily, okay? And that's the thing about this class, is because we're still learning how to properly journalize our transactions. There is no need to scratch out, delete, or anything, right? You just go back in there and you just edit the information, right? Just like QuickBooks, right? If you made a mistake, you just go back and edit it. That's the great thing about technology, okay? However, let's say I recorded a transaction and I forgot something, or I recorded a transaction wrong. I accidentally fat fingered a number, or when I record the receipt, I thought it looked like a 5, but it was actually a 6, okay? Whatever mistake that you decide to put in your journal, this is the correct way to fix that entry, right? 2 ways. Number 1, reverse and re-entry, which requires 2 general journals, right? 1 to reverse the transaction, and 2 to actually enter it back in with the correct amount. Get it? So that's why it's called reverse and re-entry, okay? The second way to do is called error cancellation, where we take the journal, right? We compare and contrast to what it's supposed to look like. And then from there, we determine, am I overstating an account or am I understating an account? And you're going to record the difference, okay? And we'll take a look at an example for both of them, okay? So let's start with the very first one, okay? So on September 15, you decided to purchase office supplies with cash, okay, in the amount of $65. However, okay, maybe at the end of the day, you decided to record the transaction, and so now sales taxes is included, and you end up recording this transaction as $56 instead of $65, right? So here I journalized it on September 15, office supplies for $56, cash for $56, right? Then you realized, hold up, I should have more money in my pocket. Maybe you had $80 in your pocket and you realize, wait, if I charge $56, I should definitely have more. Then you pull up the receipt to realize I entered in the wrong amount. So now we're going to be using the reverse and re-entry, okay? Now the best way to understand this is pretty straightforward, right? I purchased office supplies at the store and I bought it with cash. Now, in order to reverse the entry, it's simple and straightforward enough, okay? I need to undo the transaction, or in this case, I'm going to go return those supplies and get my cash back, all right, for the wrong amount. And that's how you reverse it, right? I'm going to say I'm going to return it to get cash back for the $56, and I'm going to return the office supplies for the $56, okay? That's the first journal right there. Then the re-entry is going to be, I'm going to re-enter the same transaction, or in this case, I'm going to go back to the store and rebuy those exact supplies, but I'm going to record it for the correct amount. So in this case, I'm going to record my office supplies for the correct amount of $65, and I'm going to record my cash for the $65. Okay, and my entry here or my description here is to correct the error on the 15th of September. Right? So that's how we do the reverse and the re-entry journal. Okay. So in the very beginning, I entered it incorrect. I put in 56 instead of 65. And now this is what I'm going to do to fix that error, right? I'm going to undo it, which is the reverse the entry. So return the supplies, get my cash back. And then I'm going to repurchase the office supplies and spend it for the correct amount.
Everything happened in the same date.
In this case, we figured it out that we ended up doing this, right? Now, it's not always going to be the same date. It might be 5 days later, 10 days later. You might go through your receipts again and be like, and compare your contrasts to your books and be like, oh, wait, I record this wrong. Okay, so it doesn't have to be necessarily on the same date. It could be a couple days later.
So you can revert. You don't write it. If you do that, you don't write the date from when you buy the supply. You just write the date that you doing the reverse or whatever.
Exactly. So whenever the day that you find out that you made a mistake, that's the day that you record it. Yes, correct. Right? And then in their notes, it's going to be that you're in reference to this date of where the transaction actually originally happened. Now we're going to talk about error cancellation. So once again, in this context, right, when we look at our accounts, okay, we need to recognize two things, right? We need to recognize, okay, in my books, I recorded that I spent $56, but in reality, I spent $65. So in this case, I am short office supplies, all right, and I'm definitely short in cash because I don't have the remainder money in my hands. I have less. Right? So in this idea, right, you need to find the difference between your error and the correct amount. So what's the difference between 65 and 56? $9. But now this is where I have to really think, okay? In my books, I recorded my office supplies to be $56. It's supposed to be 65. So in this case, that means I need to add $9 worth more to my office supply so that in my ledger, it will say I have $65 worth of office supplies. Okay? Same thing with the cashier, right? I spent $9 more than what I originally recorded. I didn't spend 56. I spent 65. So therefore, I need to subtract $9 more from my account in order to reflect that I spent a grand total of 65. Okay? And there you go to correct the error on the 15th of September. Okay? All right, easy enough. We're going to do an exercise after this, so you'll be okay here.
Just, if I understand good, you just record the difference. That's all.
Uh-huh.
$9.
Mm-hmm.
Okay.
Mm-hmm. That's it. Now, recommend wise is that you should use the reverse and re-entry just because that way it prevents a lot more extra errors. Because if I have to think really hard, which accounts am I short in or which accounts I have too much in, that can also cause you to create another journal entry that could be wrong. Okay, so in this case, right, if I decided that I am going to credit my office supplies $9, right, and debit my cash for $9, right, there I make another mistake that I actually have to correct again. So that's a double error that I've made because this part of calculation is and understanding what which accounts that need to be increased or decreased, right? that can be difficult for some people. Okay, so that's why reverse and re-entry is usually for more beginners where they're not quite sure, or just to make sure that they are doing the accounting correctly would be the most likely one to use. Where this one is more for advanced level of people who've been bookkeeping for a while, right? Who can understand where the money needs to go. This one's going to be more widely used for, you know, advanced users of accounting, right? People who have more accounting experience, who understand how a flow of a transaction really works and which accounts are going to be affected. That's one that this one's going to use. So both methods are correct. They're not wrong. They're just, both of them do work and they do the same thing. However, one of them prevents you less likely to make more mistakes, where this one you could possibly have another mistake here. Okay. Now we're going to talk about T accounts. What are T accounts? Now, T accounts usually it's just a quick way to give you like a little sum up of an account. In this case, this can be the scratch work that you could put on your journal on the side of the journal. This just doesn't make your journal inaccurate or correct or scratching out anything. It's just in case you're like writing too many checks and you realize, wait, I wrote too many checks out. I'm gonna do a sum up of how many checks I actually wrote. So usually this is what it is. It's just a quick little summary of, well, if I started with this many counts and I wrote this many checks out and I, deposited this much money in, this is how much I should have at the end of the day. Which is, it's a quick way to do that. Okay? Now, there is a better way we're able to do this, and that is called the general ledger account, right? So in this case, this is just if you're on your general journal and you just need a quick sum up of your accounts, boom, write it right there in your journal. But there's actually a proper journal called, or a proper account book called the general ledger, which gives you access to every single account that exists with their associated running balance. So the transaction I just showed you earlier, right, this journal earlier where I journalized all the transactions that happened here, right? I had a sale, so I debited my cash. I paid for supplies. I paid for rent, right? And that's what the general ledger does. It takes the transactions that you have in your journal and it pops them into your ledger, right? But in this case, it gives you a running balance. So, for example, here on the 31st of August, I started out my bank account with $5,124, right? I had sales, right? Which increased my bank account by $154, which now my account balance is now $5,278. I wrote 2 checks right here, credit on both sides for $500 and then $65. So then that's going to give me an account running balance. So it's going to update my account so I know how much money I have in each account. Now, this is definitely rule of thumb, especially because if you're in the business of doing accounting for a company, right? You better know at all times how much money you have in your checking account, because you never want to go into the situation where you don't have enough money and you're writing check after check after check, and then you find out that you wrote way too many checks and your account is overbalanced. So this is called the general ledger, which gives you an account balance in every single account that's on your chart of accounts. Okay? Now, here, the difference between your journal and your ledger is going to be that your ledger is going to have an account balance. It's always going to have a running balance, where your journal is your day-to-day transactions. Okay, so let's compare, right?
Repeat again.
The journal, right, is just a list of your day-to-day transactions, right? Okay, here I had a sale. Here I paid for rent. Here I bought office supplies. That's it. Your ledger is going to give you a running balance because here it keeps track for you, right? I had a sale, I increased my checking account. I wrote a check for rent, decreased my checking account. I paid for office supplies, decreased my account. Okay? So the difference between a ledger and a journal, your journal is just your day-to-day transactions, while your ledger gives you a running balance and it in every single account that exists in your chart of accounts. Okay? That's the difference, okay? They do the same thing, right? You're still posting the same thing where your journal entry is going to be entered in here as well, right? You're going to copy everything from the journal, but the only difference is you have those extra 2 columns to create your running balance. Okay? Okay, chapter review. Once again, we talked about what a chart of accounts is. Right? We talked about how to properly journalize a transaction, right? Our goal is to make sure our debits and our credits match, right? We have 2 ways to correct our entries, right? Whether it's using the reverse and reentry, or we can use the error cancellation method, right? And once again, T accounts are just so then you're able to sum up a real quick on your journal, right, on the side. But we actually have a place for that, and that's called the general ledger, okay, which is a separate book from your journal, which allows you to keep an account running balance in each account that exists in your chart of accounts. Okay? Any questions?
Do you need to do the T's or you do the general ledger and that's all?
Like I said, the T account is only if you realize that you just need a quick sum, like a quick sum up. You could do it right in your journal. But the best way to do it is just do it in your ledger. That way, you don't just sum up a small area. You are constantly updating each account. Okay? All right. So let's go ahead and go over the exercises. So, Nancy, if you already left, you already left?
I'm still here. I'll go through the exercises for a few minutes.
Okay, you sure?
Hopefully I can get through most of them, yeah.
Okay. Excuse me. Okay, let's go. Let's go through these. Number 1. What is a chart of accounts?
Is that just the listing of all of our accounts?
Mm-hmm. List of all accounts. Okay, that's important, right? It's a list of all of the accounts that exist for your company that you're going to be using for your journal. What is a general journal?
To say like um, general ledger, but
Where daily transactions are recorded?
also please
Correct. It's a book where you record business transactions. Good. What is a general ledger?
the same like the general journal, but it give you a balance.
Good. So it's another book where all business transactions exist. Okay. So I'm gonna guess in summary I'll just put like a general journal, except you have a running balance. Okay. So I'll obviously upload the correct answers to this, but that's good. That's a good summary. Good. What are the 7 steps of the transaction analysis?
Recognizing the transaction.
Mm-hmm. Good. You got to recognize the transaction has occurred.
To understand how the transaction affect the business.
Mm-hmm. Step 3.
We have to figure out if it affects or if it increases or decreases the total account balance.
Mm-hmm. Increase, decrease accounts. Good.
To use the business chart account.
Use.
To know which one.
Mm-hmm. Good.
To use debit and credit rules.
Yes. Debit and credit system. Good. Number 6.
Figure out which journal to record it on.
Good. Determine which journal. Okay. And last but not least, steps number 7 says.
So you do it. You start to record. Huh?
Good. Do it. Record transaction. Good. Okay. Number 5. How is the general journal recorded? Okay, in terms of time. Chronologically. Yes. Chronologically. Good. All right. Number 6 says, when recording the general journal, what goes first?
Debit.
Yes. Your debit accounts will always come first. So debits go first. Okay. Number 7. Okay. At the end of at the end of journalizing, what must be true?
Shouldn't your debits and credits always match?
Yes. Debits equal your credits. Good. All right. What are the 2 methods to correct a journal entry?
Reverse and re-enter.
Reverse and re-enter. Good.
And cancellation.
And error cancellation. Good. So here, we're going to take some time to kind of practice journalizing real quick. Well, I guess it's not going to be very quick, but in this case, we're going to practice journalizing our transaction. So here I have a chart of accounts all set up for you, okay? And we're going to go through a series of transactions, and we're going to properly go ahead and execute our transactions, okay? So very first one here on January 1st, okay, you paid rent for $500 cash, okay? So let's take a look at our chart of accounts, right? How does this affect our business? right? We're paying for rent, so we can open up our shop. Okay. Let's use our chart of accounts. Do we have a cash account?
Yes.
Yes, we do. Do we have a rent account?
Rent expenses.
Yes, we do have a rent expense account, right? Account number
Yes.
660.
6.
Okay. Now, in this case, right, how do we use the debit and credit system? So this is where your accounting model is going to come into play. So in this case, I am paying for rent, $500.
Okay, this is a cash, no?
Yes, it is cash.
Okay, and you're paying for rent. So rent expenses.
Yes. Good.
The description. Oh, the date first. Now you have
Mhm.
put
January 1st.
oh, January 1st. So it's rent expenses
Good.
and I don't know the account the PI. I don't know.
The PR, okay. What account number is rent expense?
600, 660.
660, good. Okay.
660 and it is a debit, no?
It is a debit, correct, because we're paying, right? We're spending money for our operations, which is to pay for rent. And how much are we paying rent?
So that's $500.
$500. Good. Okay. Now, what is going to be my opposite account? What's my credit going to be? Because I need to make sure my debits match my credits.
So the cash is gonna be the credit, no?
Yes, excellent, right? Because we used cash. We paid it, right? We're decreasing our assets, okay? Because we're spending money. My cash account is account number.
I don't know which one it is. Let me see. Cash, cash, cash. Cash is 100, no?
Mm-hmm. And we paid $500. Okay. So here, I'm not going to have you guys like practice the descriptions and parentheses. We're just going to practice journalizing and recognizing the account. Okay. Now, another rule here is that every time there's a transaction or a break in between transaction or you're complete with a transaction, usually skip a line. Okay.
Okay.
So then on January 5th, okay,
You need to write a note that you pay the rent, or is clear with the rent expenses?
in this case, like I just mentioned earlier, I'm gonna have you not practice that part. We're gonna just practice understanding what accounts are gonna be where, and that's it, right? We'll practice that. We'll practice that later on. Okay. Right. So January 5th, okay, you purchased inventory.
Inventory.
100 items for $1 each, okay, with cash.
So we have the inventory.
Yes, we do have inventory.
So the inventory it is, I don't know which one, 150.
150.
That kind. And it have to go to the debit.
Yes, because we're buying inventory, right? We're increasing our assets. Okay. Now, how much did I actually pay for this inventory?
You pay $100 cash.
Mm-hmm. We're paying $100 in cash.
So it's going to the credit to the other side.
Yes. For what account?
Oh, 100.
For what account?
Oh, credit.
For what?
Cash. Sorry, cash.
Good.
Everything.
Good. Well, cash was account number 100. Okay, good. Right. So this is where you put in your description that you purchased 100 items for $1 each. In this case, I'm not having you practice that just yet. Okay. Then on January 8, we decided to purchase a machine for $750 cash.
A machine. That's fixed, right? If that's an asset fixed as equipment.
It is equipment. Good. So in this case, account number 160.
160, yeah. And it's going to debit. How much was it? 600. 750 debit,
Mm-hmm.
and we buy cash. So
Mm-hmm.
we have again cash 100, and it's going 750 to the credit.
Good. Okay. Easy so far?
Yes.
All right. So next one here on January 10, we decided to purchase supplies for $56 on an account.
So we have supplies 110.
Good. Supplies for 110. Okay.
And it is how much we buy? $56 in the debit side. And we pay purchase supplies on account. We pay credit or what's that on account?
That's correct, right? This is where we're taking a look here where I purchased it on an account.
Mm-hmm.
Okay. Now, if I purchased it on an account, right? So I didn't pay cash. So what did I just do?
Credit.
Credits, right? What is that? I have credit with somebody, right?
Yeah, so you have to. It's obligation. It's a liability. It's credit.
Correct.
No.
Yes, it's a liability. Now, which account reflects that I'm owing somebody on an account?
That's a good question. I don't have any idea.
Take a look at the chart of accounts. What options do I have for liabilities?
Cost and goods. So no. No, that's not the one. Let me see. 1 second. So current liability. Yeah, it can be current. Yeah, it's a current, huh?
It is a current liability, correct. But let's take a look at what account do I have available to use.
You have just good cost and sold. No, that's expensive. Loan? No. Let me see. That's the account payable 200.
Yes, accounts payable for
Oh.
200. Good.
So that's what you put it on the bottom.
Mm-hmm.
Account payable to okay.
Yes, because in this case, right, I created a liability. I didn't pay anybody, right? I didn't pay yet. I owe someone on a credit. Right? Good.
So that the other one is going to the other side. So it has to be
Mm-hmm. 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 So in this case, accounts payable because I'm increasing my liability, right? How do I increase my liabilities?
So in credit.
Yes.
Oh. The supplies is going to credit, and the account payable you increase, so you go to debit.
No, wrong way.
Wrong way.
Okay, so in this case, I'm increasing a liability, right? How do you increase a liability?
Yes, I can check that. So in the credit side, you increase the liability.
Mm-hmm. And when I purchase supplies, I own the supplies after I walk out the store, right? Those supplies are mine.
Oh, so you have it? Yes, but yours. Oh, okay. Yeah, I know. Because no, I write that, but I write that you pay that we pay cash, but it's not later we.
Oh, okay. Well, in this case, no, we're not paying cash. We're paying it on an account. So therefore, we owe the vendor money. Okay, good.
Okay, so we're going to January 12.
January 12th, okay? So now you had cash sales of 25 toys, which you sold for $5 each. No sales tax.
Sales is a revenue.
Sales is a revenue, right? That is an option.
So,
Okay, we're not going to do inventory just yet, right? Right now we're focusing on just the transaction at hand. I sold something to people.
mm-hmm.
And I sold it for $5 each. Okay? And I have another word right there. You had cash sales of 25 toys at $5 each.
So it's cash sales?
Right. Yeah. We received money, right?
Uh-huh.
Because we sold the product.
Yes.
So in this case, yes. So we're going to increase our cash flow because that's exactly what we did. We sold our toys to our customers. Now, in this case, what's my credit account going to be?
100 something, 150, 100, something like that, no? I check. How many we have?
25?
25, 125.
Good, 125. Okay, so that means I received $125 in cash.
And cash. And
Okay.
then we have sales there, no?
Yes, good. My credit account here is sales. Okay, which is account number 410. Good.
And it's going to the credit side.
Good.
It's going slowly, but it's going.
That's good. No, good. On the very same day, you need to adjust your inventory for the cost of goods sold, okay, for selling those items, okay? So in this case, this is where I need to calculate how much it cost me to sell those 25 toys. Because I sold it to my customers for a selling price, right? But how much did it cost me? How much did I buy it for?
We don't know.
We do know.
Yes.
How much was when I originally purchased my inventory? How much did it cost me?
The inventory that we have here, that are for the $100 that are for the toys.
Yeah.
So they have a relation, the January.
Mm-hmm.
So they cost me $100.
Well, that's for 100 of them. Did I sell 100 of them?
25. No, you sell 25.
We only sold 25.
So they cost you $25.
It cost you $25. Good. Now, that's calculating the cost of goods sold. Do I have an account called cost of goods sold?
Yes.
Yes, I do. Right? Am I going to debit my account or am I going to credit my account for the cost of goods sold?
To credit.
Why would you credit your cost of goods sold?
What did you say? I didn't hear.
Am I going to debit my cost of goods sold or am I going to credit my cost of goods sold? In this case, I got rid of my items, right?
Mm-hmm.
So, am I going to increase that?
Yes. No, you sell them. I know, no. It's an expense.
It is an expense. How do you normally?
It's debit in the debit.
Correct. Good. So my cost of goods sold account is account number 600. Okay.
Mm-hmm.
So in this case, right, this is the same day. We're going to debit our cost of goods sold, right, which we've already calculated to be $25, right? Because we sold 25 items at $1 each, right? Now here's the keyword here. I need to adjust my inventory. Right? If cost of goods sold is directly correlated to inventory, how do I adjust my inventory?
So 75 you have enough, but from the inventories you have left.
Right.
right? 100.
That's correct. But right now, how do
Mhm.
I take the inventory out?
So you go with 25 down on credit, no? You
Good.
decrease
I'm decreasing. What am I decreasing?
the inventory, no?
Yes, excellent. Yes, you're decreasing inventory because you got rid of 25. You need to put in your books that you're taking $25 out from your inventory. Good. For the $25. Okay? So in this case, my
I don't have your
inventory
books.
account, that's fine. You could always print out your sheets over and over again.
Mm-hmm.
So good. I got rid of $25 worth of inventory.
So
Okay.
that's adjust.
Yes, this is how you adjust inventory. Good. Okay. Last but not least, on January 15, you borrowed $5,000 from the bank.
That's a loan.
That is a loan, correct. Now let's take a look.
Liabilities. We have a 250.
Liabilities,
That's a loan.
250 for loan. Okay, good.
And is going to do that increase to the credit, no?
Increase to the credit. Good. Okay, so January 15. Oops, we're going to increase it on the credit side, right? We got loans.
5,000. Loans. And that increase your cash, no?
Excellent, right? Because you borrowed money. So that instant becomes cash. Right?
What number, what account is the loan? Ah, you write like that? So you don't write the first, oh, you have to write that. That I didn't pay attention.
Yes, because the debits come first.
Yeah, debit is coming first. Yep.
Mm-hmm.
So later I'm gonna switch it.
Okay, don't
But I
worry.
put it on the way.
This is for practice. This is exactly why I have this exercise, so it helps you practice. Okay, good. All right,
I have to fix it.
that's okay. Okay, good.
250 and the cash is 100. Okay, so that's all.
Okay.
Now we have
All right.
reverse.
Last but not least, now we have to reverse our entries, right? So very first one right here on question number 10, using the transaction on January 10, right, from above, you recorded that the supplies were $56, okay, on January 20th. You realize that it was actually an error and the supplies were supposed to be actually for $65. Okay, so record using the using both methods. So first one here we have method number 1 is going to be the reverse and re-entry method. Okay, so now right it is January 20th this time. Okay,
January what?
January 20 because we find out 10 days later, right?
Mm-hmm.
That wait, I wrote a mistake in my journal, right? Because originally on January 10, you wrote that you had office supply or you got supplies for $56 on an account. Okay? So how do I reverse that? Because that's not right. I spent 65.
So you doing like you sell the supplies and then you buy it again
Uh-huh.
for 65. So I don't know. You sell sell so you do and you sell an inventory cash and inventory or how do you
Okay, so how did I pay for my supplies?
use cash? No?
Let's take a look at that transaction one more time.
$56 supplies.
How did I pay for my supplies?
Cash. I cannot see anything else.
Well, no, when I originally bought it,
$56.
$56. But what did my scenario said? What did I purchase my supplies on?
Transaction.
So here, okay, January 10.
Oh,
I
we back to
purchased
the
supplies.
supplies. You didn't pay for them.
No, we didn't pay for them, but how did we pay for them? What did we do?
Account payable.
We had it on accounts payable. Good.
So you have to back to the other exercise to record that I got it.
Mm-hmm.
So account payable.
Good. Right. We got to reverse the transaction by putting back the supplies in accounts payable. Good.
You have a 200 account, and you have to go to debit. No, you decreased $56 of debit. Okay, that's right. And then is supply.
Mm-hmm.
Right? So the supply is 56. Okay. Oh, it is the same. What we're right here. I got it. So 110, and it's going to the credit. That's how we sell. Now we have to buy again,
Yes. Now we have to buy it again.
and we don't pay it the same.
Yes.
So sell supplies because it's gonna go to the debit.
Mm-hmm.
So for $56, and you have account payable for $56.
Not 56. Not 56.
No, it's 65.
Good. There you go for 65. So this is using the reverse and reentry method. Okay.
It goes to 65.
Okay. And this is where you could go ahead and practice your little entry here, right? To correct error on January 10.
Yeah, I know. I don't remember, but I know.
Okay.
So now we have a $9 difference.
Mm-hmm.
So that we record. So the same.
So
we have to buy $9.
yes, so right, that's the difference between 56 and 65 is $9, correct? Good. Now, which account are you short in? Right? Because if I originally said that I bought $56 of supplies and I charged my account for $56, am I short supplies? Do I need more supplies? Do I have too much supplies? How am I going? Where am I going to put this $9 difference?
The account payable is going to $9.
Now, am I increasing my accounts payable by $9 or am I decreasing my accounts payable by $9?
Increase it, account for $9.
Okay, so if I'm going to increase my accounts payable by $9, am I going to credit or debit that account?
Credit.
Correct.
Okay, so the supply is $9 debit.
Yes, supplies are going to be $9 debit because you need $9 more in supplies.
Okay. That's more easy than the reverse, no? I think so.
I mean, it's up to you, but that's sometimes like I had another student go, oh, you got to put accounts payable and then supplies, but then that's saying I paid too much, but I didn't. I paid under.
Mm-hmm.
Okay, so to correct error on January 10. Okay.
All right.
Good, excellent. All right, so again, these worksheets that I have on the Google Classroom, you can always print them over and over and over again because they're empty, and then I posted answers afterwards. Okay, so good job. Do you have any other extra questions?